Early exchange, shaping policy, advancing development.
Let's look at our big story, which our conversation is going to start from the Eurozone, where the expectations ahead of the European Central Bank meeting, which is slated for Thursday. There are concerns about what will be the decision of the ECB as regards the benchmark interest rate as across Europe. There are expectations as regards the growth increase to slow down to 4.3%. How is this going to play out as the European Central Bank holds its meeting on Thursday? That's going to be the thrust of our conversation. Now, joining us in this conversation, we have Kelechukwu Godfrey, who is a banker and financial educator. Kelechukwu, glad to have you join us on Early Exchange this morning.
Hi, and good morning. It's glad. It's good. It's very good to be here.
Good to see you again. We are at a moment where European Central Bank is preparing to have its meeting on Thursday. And as a result of this, there are apprehensions, expectations as regards the interest benchmark or the benchmark interest rate. Now, there was a survey conducted by European Central Bank which revealed that wage increase is going to slow down to 4.3%. How do you react to this at a crucial time like this that ECB is preparing for its meeting on Thursday?
Wage increase actually slowing down is primarily a response to inflation, and as things get by, when inflation was actually high, companies had to increase wages significantly to help employees keep up with the rising cost of living. Now that inflation is actually coming down, these companies don't feel as much pressure to raise these wages. I'm going to give an example using maybe a car manufacturing plant like Volkswagen. Like during the period of high inflation and the cost of raw materials and parts are actually rising, and Volkswagen had to offer higher wages to retain skilled workers who were also facing higher cost of living. But basically, as inflation is stabilizing, the cost of this material and parts, will definitely get to drop. And Volkswagen might, slow down its wage increase accordingly. I'm talking about Volkswagen as a company. And I believe that this reflection will go to other companies as well. Now, we're looking at slowdown as a reflect of an overall economic conditions. Now, you've seen supply chain disruptions over the last couple of periods. The Suez Canal was blocked. Suez Canal was blocked. Then the Red Sea had pirates disrupting activities, right? So all of these things. I'm also looking at geopolitical tensions across the Eurozone, the case of the Russian and Ukraine war. All of these things, and to look at the fact that we are coming back. This is a continent coming back from a post-pandemic period where transactions and business activity were stifled. So this stability presently allows companies to plan for their finances more confidently without needing to react to rapidly changing conditions, and which includes stabilizing and wage increase as the time goes on.
Godfrey, rather. Okay, so are there any specific sectors or categories that are expected, to feel this significant growth, in the wages, if you may?
Okay, so we're looking at the retail sectors. We're looking at also in the design industries, for example. So since we're looking at the stifled wage period, people have to work efficiently with what they have in hand, their budget. If I was someone who would always want to get a Zara or one of the designers, I look at my budget and I tell myself, at this point, since we're having like a wage cut and a wage decrease, right? I need to plan for things that are more essential, go for more my needs and not my wants, basically. So that would definitely affect some industries. We're looking at industries like the hotel and hospitality, tourism. We're looking at manufacturing. We're looking at clothing accessories as well. So most of these industries are actually going to feel the heat as time goes on.
All right, now let's look at the survey conducted by the European Central Bank. About 57 companies, were involved in this survey. And if you look at the peculiarity of these companies, they are large companies. They are not small players, in this zone. Now, let's look at what will be the impact of this forecast, on business operation of some of these big companies and even small companies as a result of this development, where wage increase, if it's to slow down to 4.3%, what will be the impact of that on business operations, the business environment? And what would you expect business owner to do to ensure that they stabilize or find a way around this kind of development?
Okay, businesses will be looking at reduced consumer spending and also slower growth. In the area of where wages grow slowly, people have less money to spend. For example, if an employee at a supermarket chain like Tesco didn't get significant raises, they might cut back on buying on non-essential items like I talked about earlier. That and also when people spend less, businesses earn less revenue as well, leading to slower economic into slower business growth and also slower revenues. I'm looking at Apple, for example. Apple has seen a decline in the last couple of months, the last couple of periods, because we have fewer people buying its consumer goods and tightening their budget. So what companies will have to do at this point is to either pivot or look for discount offers to attract people back to buying. Look for things that people are actually more focused on, essential needs and services that people cannot go a day without. For example, we're looking at Netflix. People are looking for alternative means of, having consumer entertainment, and people are declining Netflix subscriptions and going for other cheaper subscriptions as well. So at this point, I think businesses will have to cut back on your pricing and look for something that can be more accommodative and something that can, get the people to want to bring out their money once again. Because at the end of the day, it is what the people have they are going to spend. You can't spend what you don't have. You can't, give where you don't earn from, or it might have to even tighten or go over budget for things that you didn't plan to spend.
All right, now let's look at the annual inflation rate for the Eurozone, which as of June was pegged at 2.5%. Now, the projection for this year is to achieve 2.0%. Would you say the Eurozone is out of the woods, when you talk about the shock being provided by the global tension, and if you look at the escalating rate of inflationary development across some other countries, achieving 2.5%, would you say there's stability in that zone?
One thing countries should actually understand is inflation isn't bad. Inflation is just an economic indicator, first of all. And it's coming down to 2.0. Achieving it at 2.0 might be a Herculean task, depending on the kind of monetary policy that the ECB decides to, put on. We're looking at, trying to cut down on interest rate and some other couple of things that they might want to work on. So these are the things we need to first look at, first of all. And I checked even grossly that their PMI is below 50%. Their PMI currently is at the manufacturing PMI is at 45.8%, which means that it's actually receding. Manufacturing companies are actually receding in activities, right? And one major thing we need to look at is what affects inflation is when you have too much money going for fewer goods and services. If companies start receding in production and manufacturing, it means that there is a problem that needs to be worked on. So the question is, why are these companies receding in the first place? So the government needs to look for a way to work on monetary policies that can help the economy get back on its feet once again. So achieving a 2.0 is just a matter of the policies they try to bring on board.
Okay, so slower wage growth could have positive and negative consequences. Could you just run us through some of those, the positives first and the negatives?
Okay, slower wage growth would basically tighten up on inflation because money isn't circulating as much as it's supposed to circulate. People aren't spending as much as they want to. So it would mean that people would just rather have their monies kept in a safe place and actually pulling them out to actually spend, which means the government has something to work on. When we're looking at things like bonds and treasury bills, they can have something to fall back on and work on and actually utilize to get the economy and the country or the continent working back again. But on the other side, like I said earlier, it will stifle that in the area of manufacturing. For example, like I stated earlier, the PMI has reduced to 45.8%, which shows that activities in the manufacturing industry are receding. Now, one major reason that is making it recede is because there is no turnout on revenue. People are no longer purchasing. Spending power has reduced. So when spending power reduces, you have a stifled economy once more again. So the government needs to get people to get people to spend, needs to get people to spend back again, bring out your money. And they could do this by increasing interest rates to make basically financial assets more tangible, again, more lucrative and more competitive, in the sense raising the interest of maybe their treasury bills or their bonds or whatever monetary policy tool they might use in trying to get people to bring out their money once again.
All right, now let's focus on the ECB meeting slated for Thursday, where expectations are high as regards the benchmark interest rate. What are your expectations from the European Central Bank as regards the decision on what to do as regards the benchmark interest rate? There are three options: to reduce, which is not likely, or to maintain the present rate or increase it. Now, what are your expectations and what would you advise should happen at the cost of that discussion on Thursday as regards the decision on benchmark interest rate? Would you expect an increase?
I am actually expecting an increase. If they want to get things rolling back again, I am expecting an increase. I'm looking at the case of Nigeria that we've been where we have just strategy where to see inflation it has definitely not been results. But in a situation whereby country where there is stage for that, increasing interest rates would have very positive impacts on the economy, very, very positive impacts. So I'm expecting the ECB to actually increase the interest rates.
Let's consider these options and implication. You are rather going for an increase. What will be the implication of that compared to if ECB decides to maintain the present rate to create stability? Increase could mean some implication for investors who are already battling with certain things in their businesses. So let's look at the two sides. If there's an increase and if there's a decision to maintain the initial rate, which is at 2.5%, what will be the implication looking at these two sides on businesses?
Okay, going for an increase will mean that we will have more injection of FDIs. That's what this means. Just when this money comes, it's actually going to schools that actually create actually work. That is a major area I'm actually looking at. If it puts down the interest rate, right, it means that FDI might not be as lucrative. They might not be as much FDI as they want. But I also want to look at, it's not just interest rate that that moves the economy. We also look at fiscal policies from the government, such as task force, and direct financial support, things to boost consumer spending. All of these things are actually things that will create for more commercial activities, right? So increasing interest rate is just one part of the cycle. One is just basically one part of the cycle. The Eurozone has more infrastructure to boost commercialization. It has everything there is that can take this to the next level. But another thing it needs is sides of the which are also fiscal policy measures and also policy adjustments. It will say that it's about interest rate. So adjusting the interest rate, right? Adjusting the interest rate or taking it higher, it might make borrowing more expensive, quite right? But at the same time, we're looking at FDIs falling into the Eurozone space.
Well then, Godfrey, having a common currency, for Europe has helped them maintain stability, growth, as regards trade and foreign relations. Let's bring it back home. How important is it for the African continent, to have this initiative, as it will as well promote stability, growth for us and encourage development and investment?
Okay, we're looking at Europe is more like an economic bloc bringing it down to the A. We've tried it with the F+ currency and we haven't seen have a headwind till now. We've seen the BRICS with the movement, the BRICS. I think the problem with Africa is our diversity is keeping us at the no one wants to of course, there's not being a current statement where recently needs to get visas to travel, roughly 53 visas or an amount of visas to travel to certain country in Africa, which can be so. So I think that the moment we realize that we take out our borders and we need to, embrace one another and keep our differences at bay, I think we can have more commercialization and more economic solutions across border. Honestly, it's one area that the African community has weakened the African, weakened the economic law. If they can actually put their differences aside and work together harmoniously and look at the competitive advantage each nation has, we can do something more tangible than Africa.
Now, let's look at the approach to tackling inflation in these two zones. We're comparing Eurozone with the African continent. Now, there's something peculiar about the Eurozone. If you look at the large economies in this zone, you discover that if you do an average of the inflation rates, it's just between 2.5 and 5.0. That's like a single-digit inflation rate compared to Africa, where most Africa countries, they are battling double-digit inflation rate. Talk to us. What do you think the Eurozone is doing in a peculiar way that the African continent can learn from as regards tackling inflation and the results they've achieved in the last few months? What are the lessons for the African continent here?
The first one that I'm going to point out is political stability. Right, the Eurozone has shown some level of maturity when it comes to politics. Right, we've shown a very high maturity state and expressing national interest between nations and between bodies. That is one thing that has always intrigued my interest, because every now and then it's very easy for them to move from UK to Paris down to Belgium by train, taxing multiple times for that ship box for visas or wherever it is. Once you just have a passport on the passport, but as Africans, we have the Western region is only very heavy entry activities in the hotel space where you have tabs going on head. And that is one thing that can even affect the commercial. Actually, like I said, that the differences, the cultural differences, differences between nations. If we can come together and see Africa as just one country, one entity, now this is also Eurozone also has like a single currency, which are economic law. I said there, right? And if the EU can decide this, we can be the next. And put up policies and put up situations that can help us stand and make us this entity. Things will get better. It will be easy. Let's look at the free flow of trade. Let's look at the free flow of activities. Right? It's going to be very, very easy for sub-Saharan transactions to be done without much backlogs, without much hold-ups, without even heavy scrutiny.
Let me point your attention to a statement credited to the European Central Bank as regards the meeting slated for Thursday. Against the expectation of a lot of people, a lot of stakeholders, and even business owners, that meeting might be a time for the ECB to take some decisions. Rather, the European Central Bank is saying it's a time for them to do what they call assessment, exercise. What do you make of this statement, rather than making decisions as regards the benchmark interest rates? Now, European Central Bank is saying it's a time to do stock exercise, to do stock taking of what has happened in the last few months, and also to do analysis of the indices and the data available, which might not likely be a time to make decision as likely expected. How do you react to that?
Okay, I feel it's a very wise decision instead of just putting the hammer behind the gun, right? Most times, most institutions would actually back up the reasons why some decisions are taken, or like just apportioning benchmarks as the case may be every now and then. I think most times it's very good to look at the indices that are projecting, that would need to project this benchmarks. For example, the PMI, that's purchasing minus index. You're looking at that. You're looking at the cost of living, like we also talk about wage cuts and all of that. These are things that need to be looked at. And when you're talking about taking stocks of companies and all of that, how much do these companies have in liquidity? What has been their profit ratio? in the last couple of months. How has the economy been affecting them, on a steady period? So all of these things are things you need to look at, because you can't just pull out a policy or pull out a benchmark that will even stifle economic situations or commercial situations in an entire continent. Now, this is across border. When it's being done, it's not done in just one country. It's done across the zone. Like whatever is happening in the UK is going to happen in France. It's going to happen in Belgium. It's going to happen in neighboring countries as well. So these things need to actually be put into serious consideration. You don't just wake up and just say, okay, like Nigeria, for example, you just wake up and say, okay, because inflation is at 34%, you're going to make increase interest rates with 500 basis points just like that, without even having consideration of what the common man is going through or what businesses are going through. So I think it's a very good move. It's a very wise decision to actually want to look and assess the industries and assess the economy before putting up a benchmark.
What are the policy? Let's bring it back home. What are the, policy tools that you think that the government of Nigeria will do or implement to, reduce inflation in Nigeria?
When it comes to reducing inflation in Nigeria, we're looking at the fact that the Nigerian economy is driven by two things. It's driven by the PMS one, and also driven by the foreign exchange, which is the dollar. It's driven by these two things. And if you actually want to have the economy get back on its feet again, I would start by saying, though many will not agree, I will start by saying, let's subsidize back the fuel and also subsidize energy. Because if these two things come in, cost of production for companies would actually be reduced at a very, very minimum. Majority of the reasons why majority of the companies actually leave the country is because of high cost of production, right? And when this keeps happening, right, it's not a good taste for us. We're talking about that the country is import dependent. It is import dependent because cost of production back home is very expensive. Imagine you spending roughly 5,000 naira to produce something that just by importing you might import like half the price, and then sell to a willing market that is ready to buy available immediately. But looking at that, the cost of production and even the cost of importation is on the high side. These are areas that need to be tackled. Right, these are areas that need to be tackled. I was discussing with someone earlier, some months ago, and we had this final, say that you can't have a high exchange rate and also a high interest rate. One has to go down for the other. It's either you lower the interest rates and continue with the high exchange rates, or you find a way to bring down the high exchange rate and increase the interest rates. Now, these are the things that need to be looked at categorically. Now, that is the area of monetary policy. What about infrastructure challenges that we're having? How long does it take to move products from the north down to the east? How many days and what does it cost to actually have that done? How can we move rice from this location to that location? What is the cost of transportation? And this is why I said the Nigerian economy is highly PMS driven, because transportation is of the essence for commercial activities to happen. The more we have these things skyrocketing, the more inflation will keep being in place, the more things will get harder. It's going to be a tough call. It's going to be a tough judgment call. But infrastructural policy needs to be set right. Monetary policy needs to be readjusted, and fiscal policy needs to be reaffirmed once again for things to get back in play. You can't just leave the whole bulk of the job for the CBN to handle. No, the CBN is one arm that gets the economy rolling. The Ministry of Finance is another arm, and also the federal government, the presidency, the state government. Everyone has a role to play. If no one decides to play their part, one way or the other, the ship will keep still sinking.
All right, let's get back to the decision made by the central bank a few months ago, which is to tighten up the economy, increasing the interest rate with the intention to tame inflation. Now, as we speak, according to a figure released by the Nigeria Bureau of Statistics in June, the inflation rate is at 34.4%. Would you say this decision by the central bank has yielded any positive results compared to what is happening in Eurozone, where the same template was adopted to tighten up the economy? And if you look at the result, what do you think Nigeria can do differently?
Honestly, I'd say we need to drop our interest rates. We need to literally drop our interest rates down, like very, very down, because it's stifling business activities, it's stifling manufacturing activities in the country. And even it has to get to the point that even own Aliko that they have to complain that having interest rate at roughly 30% is very high. It is very, very high. We all know that it is very, very high. We're looking at the CBN is trying to bring down the inflation. Like I said earlier, it's not going to be a one-man job. At this point, all hands need to put heavily on deck. Ministry of Finance needs to try out fiscal policy that can actually help. The presidency and the state government need to cut down the spending. Government spending needs to be cut down drastically. So it's not like I said earlier, it's not a one-man job. The CBN is just trying to do what they can in its books to actually see that things get better. But the funny part is the harder it tries, the bigger it falls. For example, you're putting interest rate at over 30%. You're trying to woo investors to coming down. For the first time in a long time, NCB has gone up to all-time high of 21%. Federal government savings bond is at 18%. Now, you're sacrificing foreign direct investments for FDIs, knowing that after 1 year, FDIs will leave and you have to also pay them back their interest. These guys are really in the dollar. It is quite nice. Our foreign exchange reserve is going up. It's quite nice that is happening, but what is the long-term effect of it? For long-term effect, we need companies back. We need companies manufacturing to be back up and running, and cost of production very at the bare minimum. But one thing Nigeria enjoys is cheap labor, number one, and human capital development and human capital. These are the things that we are very good at. We have the numbers, we have the people, we have the energy to produce, but then we don't have the infrastructure to keep things working. That is not CBN's job. CBN has tried in its way to do development finance by helping agricultural farmers and rice production, boosting rice production and boosting production of agricultural products in the country. But where has it led us? It is not a one-man job. The CBN can try its best. They can try as much as they can to try and use the parameters of interest rate and monetary policy to get the economy back running. But like I said earlier, the harder they try, the bigger the fall. Because one person can't just do everything. Comparing ourselves to the Eurozone has all the infrastructure needed. There's steady power, there's easy transportation, there's access between countries, between states. You can move from point A to point B without less issues. You can't have that same thing in Nigeria. We didn't need insecurity to even start with. You can't move from the north down to the east without, meeting roughly 100 checkpoints of police on the road because of insecurity. You can't travel without the fear of being raided or being attacked. These are things that even the CBN cannot even mediate on or even handle. These are things that interest rate cannot even solve. So the more they raise the interest rates, the more it's tightening not just the economy, it's tightening even the pockets of every single person. It's harder for banks to even borrow money to individuals because they know that with the way the things are going, you may not even repay.
All right, interesting. Godfrey, I like the fact that you're a banker, and I would like you to deploy your expertise here. Looking at the benchmark interest rate, a lot of business owners are discouraged for going for loans now. What do you think could be the likely alternative for business owners at a crucial time like this, where you have double-digit inflation and the economic environment is not suitable for proper development and investment? What do you think can be a bypass for investors who are looking for funds to do businesses? Talk to us.
Okay. An angle that should be looked at would be sales of company bonds and trying to go public. These are the ways companies can raise funds. Series A, Series B, and Series B funding. These are things that can be put in place for companies to raise funds. Because at this point, even going to the bank looks like a bad idea. The interest rates from the banks are actually going to be choke hazard at this point. It's not going to be easy to be repaid, to pay back, because it's more like being penny wise and pound foolish. But the safest way out of all of this is to either sell company bonds or to go public.
Let's wrap up with this question. Which is your expectation from the central bank in few weeks or months to come? Another MPR is going to happen. What would be your expectation and your recommendations for the CBN as regards tackling inflation? And I hope you can hear me.
Yeah, I can.
So as we move on, what would be your expectation from the central bank as regards the monetary policy and also managing the inflation rate development in Nigeria, the double digits, and some of the critical decisions that will help to strengthen growth and development in Nigeria. What are your expectations as the CBN prepares for the next quarter and also for the next MPR meeting?
Okay, currently the MPC meeting is actually holding as we speak. I said it yesterday, and honestly, everyone is hoping, not just we bankers, everyone is actually hoping that there is a cutback on the interest rates, there's a cutback on CRR, there's a cutback on the equity ratio, so that business can be done once more. Right. The banking industry is one strong industry that has been showing signs of a very strong and economic and financial buoyant Nigeria. If the banking sector starts to struggle, then at this point you can say all hope is lost. So the banking sector needs the CBN to cut back on to cut back on some policies. The CRR needs to come down. The MPR needs to come down. The rates they all need to come down at this point. The liquidity ratio, they all need to come down so that businesses can actually start booming once again. Right? Things can actually start moving once again in the country. So the hope for every banker at this point is praying that, okay, CBN, we know that you guys are doing a whole lot of job. You guys are doing great work and a great deal of activity, but at this point, please, we need to show some latitudes from you. Please cut down the rates. I mean, the 500, the new capitalization structure that is being on the way right now. You're seeing banks trying to sell shares to raise funds, doing public offers. Every Fidelity Bank, then GT and Apis are on their own now. Bank is trying to even raise its funds. So the banking industry is actually having a big hit. And like I said earlier, the banking industry is one industry that shows about the financial buoyancy of a nation, financial buoyancy of a nation. If they start struggling, at all actually moves. So at this point, all eyes on CBN to cut down on some rates, to cut down and impose some latitude on some certain jurisdictions that they have going.
This segment, tell us, in your own opinion, how much should a price of petrol per litre be pegged at? Because you talked about, reducing pump price. In your opinion,
okay.
How much?
The honest truth is, if it can be slashed by 50% thereabout. So we have in my locality in Abia State, we have on floors at 800. The honest truth is, if you slash it by 50% and have it sell for 400. The kind of economic windfall, the kind of economic turnaround we would see in the next 24 hours would be Herculean. It will be massive. And I can guarantee you that in the next 3 months, you'll be seeing massive results of cuts in the price of fuel, in the price of petrol. Not just petrol, I'm talking about petrol, diesel, LNG. All of these things, these are basic needs and necessities that an average Nigerian needs for survival. If you notice, Nigerians spend 4% of their income on food alone. So if I have food and I don't have the means of cooking it, if I have food and I don't have the means of cooking it, or I want to get food and I don't have the means of going to where I need to buy the food, it's a problem. Basically, that's why you see that people are crying and saying that there's starvation in the land. They're not saying there's starvation in the land because there is no money. There's starvation in the land because things are expensive and the basic things they need to actually survive cannot be gotten. So if there is a slash price on fuel basically by 50%, saying down to 400, there will be a massive turnaround in the economy. I kid you not. Take this anywhere, take it to the bank and cash it in. It's for the FD work.
All right, that's your
much.
opinion, that's your submission. I like the fact that you're saying 50% or pegged at 400 naira per litre, but I'm wondering if the market forces will support that as we speak. Well, let's see how that is going to play out in a few weeks or in a few months. Kelechukwu Godfrey, we must thank you for your time and your thoughts on the next thing this morning.
Thank you very much. It was nice being here.
Early exchange, shaping policy, advancing development.